Thanks, David, and it's a pleasure to be here in this beautiful surroundings. We have two great speakers here today. Their bios are in the handout, but Bob Carter, who's in charge of ratings at Moody's on municipal credit, and Catherine Mann, a professor at Brandeis. And I think given all that's gone on in the muni market this year with cities, and we saw a little bit about this with Detroit, and certainly the other story that's been in the news a lot in the last few weeks is Puerto Rico. And I can give you an example of some of the turmoil that's going on. You've seen Puerto Rico bonds in the longer end of the market trading at 9 to 10% yield levels. Think about that versus most long municipal bonds trading at 4.5 to 5%. And then you talk about some of their insured bonds. Mary was here, they're trading in the 7% level. Somebody had a large block of Puerto Rico paper that's maturing this December. So in 2 months from now, 5% bonds that traded at 98 cents on the dollar. That's a 21% annualized rate for those of you scoring at home. So it tells you that we do have a lot of turmoil out there. Our speakers are terrific. Bob spoke at a GIC conference in March back down in Sarasota, and Bob holds degrees from Union College in Michigan, and I was kidding him at the time that both schools were in the respective NCAA playoffs in hockey and basketball, and here he is returning, and Michigan's undefeated in football, so he's doing quite well. And Catherine went to Harvard and MIT, and they were actually in both two postseason tournaments last spring, so we have a lot of athletics covered among great academic institutions. I'm only going to look at one slide and then introduce our speakers. I have more, but one's going to do it. And this gives you a look at the long maturity end of the municipal bond market. It is the Bond Buyer 40. It is a long AA plus rated municipal bond index. It is what the bond funds own. You can see this goes back to before 2008. Here are the three crises. The crises at Lehman Brothers, when everybody wanted to own nothing except treasuries. So they were throwing out corporates, they were throwing out real estate, they were throwing out commodities, you name it. Resumption of normality, yields come down. Here we have the end of 2010. This is Meredith Whitney saying that most municipalities are going to go bankrupt in the next year. You're going to have hundreds of billions of dollars of municipal defaults. And we know what happened. We know the bond fund redemptions spiked tremendously, and that went on for a few months. We know that in 2012, we did not have hundreds of billions of dollars of municipal defaults, and yields started to come down. And they came down along with Treasury yields right through the end of last year. Here you have the spring, fear of tapering by the Fed, and what happened? It was off to the races again. So, and this time it was actually even worse than Meredith Whitney. We had months of June with $16 billion of redemptions, July with $14 billion of redemptions. The market has stabilized in the last few weeks and yields have started to come down. But I think what you really see out of this is that it doesn't take long to wreck the muni market, and it takes a little bit longer to restore it. So I think today our speakers are going to really try to give some perspective on that. So with that, I'm going to turn it over to Bob Carter.
Good morning. Thank you, John, and thank you to GIC for the opportunity to be here in beautiful Bermuda. I'm going to talk a little about the muni market, state and local governments, mostly the governmental side, not the infrastructure side, which is the area that I work in for the most part. I wasn't really planning in my slides, although I have a few at the end if need be, to talk too much about some of the distressed credits, Detroit, Puerto Rico, or the issues of municipal bankruptcy, but I'd be glad to answer any questions if we get there at the Q&A, or to go to those slides if you're interested. But just to give you an overview of our view of state credit generally, The U.S. states are a very highly rated sector, as you can see. We have 47 state ratings, and almost all of them, except for 2, are in the AA category. The only ones that are not are California, Illinois at A1 and A3 respectively, and Baa3 with a negative outlook. Borderline investment grade is Puerto Rico. We have them in this category because while they're not a state, they aspire to be. And so this sector has been very strong throughout the downturn, throughout all the municipal crisis, remains so, and really across our spectrum of ratings globally is one of the highest rated sectors, and there are many reasons for that, including the fact that they exist in a AAA U.S. government environment, that they have control over their own finances, and that even the smallest of them are relatively broad and diverse. I put this map up here, which is just a map of our ratings. One of my colleagues told me that the higher your title is, the more impressed you are with colored maps, so I just thought it would be useful to have this. I thought it would ring true with this group. But it's just the distribution of our ratings across the country. We recently revised our outlook on the U.S. state sector. We had a negative outlook for 5 or 6 years, beginning at the outset of the housing recession. We've taken it off now because states seem to be exhibiting some significant degree of financial stability due to the slow-growing economy, the improvement in tax revenue, particularly sales and income tax, which are the revenues that state governments principally rely on. They've been rebuilding reserves, but of course there remain areas of caution, including the weak employment situation throughout the U.S., the possible repercussions to states and local governments, for that matter, of federal deficit reduction, and governments across the U.S. are really being pressured, as we talked about earlier in the panel, by growing pension and OPEB liabilities. Just a quick synopsis of the rating changes we've made in the last few years about states. Last year, in 2012, there were 4 state downgrades, 3 negative outlooks assigned, no positive outlooks, and the U.S. government rating was a negative outlook, AAA. So far this year, we've only had 1 downgrade, the state of Illinois, whose pension and other problems are well known. We've assigned 6 outlooks. We've moved them to stable from negative. We had 5 states that we had on negative outlook along with the U.S. government because of their linkages to the U.S. government, both in a economic and policy budgeting sense. And we've actually assigned 2 outlooks as positive this past year, including the state of Michigan, notwithstanding its problems with Detroit. And we did revise the U.S. government outlook back to stable. Just a quick slide showing some of the key indicators. Principally, this one shows the employment change, that for state private sector employment, for total employment, government employment, shows the improvement. Most of you are familiar with this information. Residential construction, obviously, housing was the epicenter of the economic and fiscal collapse around the country, and housing permits are up significantly, and housing prices are also up significantly, as well as consumer confidence, indicating that the economy is in a slow, if tepid, recovery, and that has been reflected in some of the improvement in state government tax collections. Tax collections have actually, at this point, surpassed their 2008 peaks. In the first quarter of 2013 was when that was achieved. Estimates continue to be strong. You can see the personal income tax in the red line has got a number of significant attributes to it. It's clearly, as you can see, very volatile, much more volatile than the sales tax. And it's been growing very rapidly. And part of the reason for that is very simply that the income tax, whether it's at the state level or at the U.S. government level, is paid for by a very small segment of high-income filers. It's largely driven by capital gains and the exercise of stock options, which in the U.S. and in most states are treated as ordinary income, not capital gains. When the stock market is doing very well, you can see personal income tax collections do well, and when the stock market plummets, you can see those collections plummet as well. The strong rebound in the stock market in the last couple of years is reflected in the red line up there for the last couple of years, and bodes fairly well for state tax collections coming up for this year and next, unless we see some very significant reversal in the stock market. Reserves, as I noted earlier, have also been replenished. They're not at the pre-recession peaks, but there has been improvement, and we expect that there will be continued improvement in the fund balances that state governments are keeping. Shifting quickly to local governments, while we moved our outlook for the state governments to stable, we've kept our local government outlook negative at this point. The reason for that is that local governments are primarily dependent on property taxes for their principal source of revenue. State governments, except in rare instances, don't get any revenue from the property tax. Local governments derive the bulk of their income from the property tax. The largest number of local governments is school districts, and school districts get almost all of their revenue from property taxes or state aid. So because state governments have been cutting back, particularly on spending, and K through 12 spending is the largest single component of state government spending, and the property tax has been slow to recover, this sector remains somewhat pressured. This view is consistent with a report that I noted this morning. It was just released yesterday by the National League of Cities, indicating that sales and income taxes, to the extent that local governments have them, are improving, but property taxes are lagging. Even though we've seen housing markets in many parts of the country rebounding strongly, there's a lag between the growth of housing prices, assessed valuation, taxable value, and tax collections. We noted this lag on the way down, and local governments were slower from a credit perspective to move into the recession. They're also proving to be slower from a credit perspective coming out of the recession. We've had our negative downgrades outnumbering upgrades now for 6 consecutive years, and we expect that trend to continue. Just as I noted earlier, the pace of recovery varies quite widely across the country. There's some areas that are quite robust, others that are continue to lag. The most robust areas that we've noted tend to be in places that have had the highest downturn. So cities like Phoenix and Las Vegas that had over 50% declines in housing values are now having double-digit bounce backs, as much as 25 or 30% in some cases. Again, this is the point I made earlier about where local governments get their funds from. As you can see, they're reliant 29% on property taxes, 34% on state aid. So, nearly 2/3 of their revenue comes from these two sources. The rest of it is either fee-for-services, federal aid, and then there's a small number of local governments that also generate revenue from sales and income taxes. Again, I think this just makes the point I made earlier that while sales and income are rebounding very strongly, again, that's not the principal revenue that local governments rely on. You can see the property tax line has just begun to show some positive inclination. It will probably continue in that vein as we see this surge in housing prices flow through the assessment processes that all the local governments have. Local governments have made a lot of difficult decisions through this downturn, reducing their employment base significantly. We've noted that that's starting to reverse itself. Again, the largest number of local governments is school districts. As state aid was cut, as property taxes were reduced, as housing values were reduced, they were having to reduce headcount in the schools, laying off teachers. Many states are now starting to reinstate some of those state aid cuts that were imposed during the downturn. Some of the hiring is coming back, and that's having a somewhat beneficial impact on the overall economy. The municipal bond sector has been characterized as being, safe up until, the early part of the prior decade. We rarely saw anything that approximated default. We had very few speculative grade ratings. What we're noting here, of course, is that the number of spec grade ratings has increased even in the last 3 years. reflecting the huge amount of stress these local governments have been under. Of course, we talked earlier about some of the more notorious incidents of these. Oops, excuse me. What did I do here? Jefferson County, Stockton, Detroit, Central Falls, and the like. We would note that these instances, while they have increased significantly, remain a very small portion of our overall rated universe. We have 37 rated spec grade credits in our municipal finance sector. We have about 12,000 local government ratings. So the percentage of these ratings as a share of the overall market segment continues to be very small. And similar to our state ratings, this sector continues to be very highly rated for the most part. Not as strong as the state sector, but you can see we have very few ratings that are outside the A1 category, although the median is probably around A1, where our median state rating is a double A1. And you can see as you get down into the spec grade area that this is still a very small incidence. So while these components of distressed credits have been widely publicized, and I'm sure almost everyone in the room can tick off, 8 of the 10. They remain an exceedingly small portion of the overall population, and this remains a very strong, steady, and stable sector. I'll just go through very quickly a couple of slides on municipal bankruptcy and default, and then I will conclude, because this in itself could be a 2-day discussion. First of all, I think it's important to remember, I'm sure all of you are familiar, but people tend to use these words interchangeably. Bankruptcy and default are not the same. 22 states in the United States do not permit local governments to file for bankruptcy, and many of the states that do, they require permission of the governor or the state. So many local governments do not have the option in and of themselves to file for bankruptcy. Just because they can't file for bankruptcy doesn't mean they can't default. You can default outside of bankruptcy. And there are entities, Sierra Kings School District in California, that went into bankruptcy and did not default. They restructured some of their pension obligations and other obligations, but they continue to make in full and on time all of their general obligation payments to bondholders. So important to keep those separate. They're not necessarily linked. And again, I think we've seen local governments use the term service insolvency. When we talk about service insolvency, that is a tool that they've used to get into the bankruptcy court. It means pretty much literally what you would think it meant. It meant that they no longer have the ability to deliver in full the services that governments have. Governments in the United States have something called police powers. Service insolvency is another way or another tool to be used to invoke police powers. What do police powers mean? Governments have a primary obligation to serve the public health and safety and to protect it. And when they feel they can't, such as in a situation like Detroit, where you have an inability to respond promptly to fires or police calls or keep the garbage collected, governments can declare service insolvency and use their police powers to void contracts, either through bankruptcy or through a restructuring. We've learned that revenue bondholders, which we have often thought of being as outside having a special revenue consideration under the bankruptcy code and therefore perhaps outside it, may not be. And that we've always thought of debt and pensions as being separate. In fact, we always thought bondholders had a prior claim, and now we're looking at both the Michigan and cases in California, and it isn't clear that that's the case, and we'll be watching very closely to see how those cases work themselves out and what the hierarchy of prior to payment is for debt versus pensions. The other principal thing that we've noted recently is that, and this would be important from Mary's perspective and certainly from the bond insurer's perspective, we always thought that our ratings are what we refer to as expected loss, which is a simple formula that looks at probability of default and loss given default. We always thought that the loss given default for municipals was going to be very small. If you were a GO bondholder and there was a default, well, you had a right to the tax base, and ultimately you'd get virtually everything back. And what we were learning through these most recent bankruptcy and defaults is that might not be the case. So we are revising our view of what loss given default is for municipalities, and that affects our overall view of probability of default and then expected loss for this sector generally. Again, just another slide about service insolvency, debt and pensions, and recoveries. But I have some other slides on Puerto Rico and Detroit, but at this point I think I will conclude and we can get back to those issues at the question and answer period. So thank you very much.
Thanks, Bob. I've been very privileged to be at some GIC events where Catherine Mann has spoken, and Catherine's expertise is in international economics, currency flows, et cetera. And one of the reasons that we asked Catherine to speak here is in the muni world, where you have seen some distressed levels of yields, certainly relative to the taxable market like I showed in my slide. When that happens and you see tax-exempt bond yields rise significantly above Treasury yields, and in this case it was on the order of 150 basis points in some cases, it starts attracting different levels of buyers. And what you tend to see is you'll see what we call crossover buyers, non-traditional buyers. So in other words, not the individual, not the insurance company that needs tax-exempt income, not the banks, but a life insurance company, a charitable foundation or a trust, or in some cases, foreign buyers. Now, the foreign buyers supposedly started to make their mark in seeing the municipal credit back in 2009 when the Build America Bonds program first came into existence. They're not issuing them anymore since the end of 2010, but the idea was they got somewhat familiar. I don't have any hard evidence of this, but I can tell you that about a month ago, there was a New York City general obligation deal that got hung up in the market. It was about a $400 million deal. It was only about half done. They were looking at cutting the yields, which looked pretty attractive anyway. And then suddenly at the last minute, they got a large order, and they said it was from a European buyer. They didn't specify whom. It cleared up the whole deal, took half of the deal. So it tells you that, you know, at certain levels, things make sense, even where tax exemption isn't a crucial part of the investment decision. So,
the world. Okay. So, yeah, are foreign investors the new kid on the block when it comes to investing in municipal bonds? And John has already sort of given us a little bit of a clue as to why I got involved with this question, because, you know, my ears perk up when the word foreign comes in to the vocabulary. And if it's not foreign, then I sort of don't really pay much of attention to it. So, you know, here are some headlines that have, you know, that perk up my attention. You know, overseas buyers increase municipal bond holdings 15% to $83 billion. Now, usually, of course, I use the word trillion when I talk about international capital flows, but nevertheless, it's got overseas in it, which is, you know, foreign. Or in 2012, you know, this is past the Build America bond stage, foreign buyers eyeing U.S. munis from the bond buyer. And then, you know, more recently in a governing.com, which I don't really know too much about, but it was an interesting article, you know, their future may lie in foreign investors' hands. Now, PIMCO, who hasn't been doing so well with regard to bonds, didn't think that there would be so much interest going forward in terms of foreign buyers. The other reason why I was interested in this is that about a year or so ago, year and a half or so ago, there was a Global Interdependence Center conference in Philadelphia on debt rating agencies role in the global debt capital markets, past, present, and future. And at that time, I looked at sort of foreign purchases of what I called at the time no default assets. And I compared the blue line, which is the U.S. Treasury percentage of total financial assets, the flow of cross-border financial assets, rose, dramatically in the crisis they were, 3 times the total flow was into U.S. Treasuries. Now, it came down over the subsequent quarters, and I only took this is exactly the slide that I used at the time, and I compared that to the munis. Again, munis as a share of the flow of total financial assets, which was 3.5% of the flow in annual terms back in 2009. And so when I put up this chart, I said, well, the orders of magnitude are really, really different, but the patterns are the same. And so, so this got me involved back a year and a half or so ago, looking at the data then. And the fact that these were, looked like there may be something happening here in the muni market with respect to foreign investors, it seemed like a good time to look at this again with data that is more up to date. So, there's actually very little research on the behavior of foreign investors when it comes to potential interest on the part of buying municipal securities. These 2 articles are the only ones that I could find, in fact, and both of them are sort of discussion articles about what should be the factors determining foreign participation in the municipal market. And they actually don't have any empirical analysis because there isn't any data in these articles. And so that also sort of made me say, okay, well, can we find any? And so they argued that, munis, the demand for municipal bonds by foreign investors should be related to some combination of U.S. Treasury yields, the spreads, which we already talked about, already saw earlier, the degree of taxation or not taxation, but also a lot to do with the degree of risk aversion on the part of the buyer, and substantial interest in both of these articles put forward on the regulatory attitudes and political attitudes of the local municipalities and their aversion to creating an instrument that would enable foreign investors to actually participate. So in terms of some of the factors that may be disincentives for foreign investors, it may be the issuers themselves don't want foreign buyers to hold their securities. So this was all, this sort of, that sort of sets out an agenda to see what we can find in the data. So there are a couple different perspectives we can use to look at the degree of foreign exposure in the marketplace. The first one is to just look at the domestic market. What is the foreign share of municipal bonds that have already been issued in terms of outstandings? And then, of course, there is the foreign perspective. I'm a foreigner, I have an investment portfolio, and what is the share of municipals in my portfolio? And then within the foreign investor group, you can look at foreign official investors and foreign private investors. And then I finally also looked at 2 other sources of data that might be either corroborate or would not corroborate some of these official data that I'll be showing you, and that is the Municipal Standards Rating Board's new online system, EMMA, which I'm not sure exactly what it stands for, I can't remember, and then Google. Okay. So let's talk about the domestic perspective first. So the issue here is what is the share of the total outstandings of a particular asset class that have been issued by a U.S. issuer? How much of that is owned by foreigners? So the black line that you see in there, and this goes annual data from 2002 to some of it I have through January 13, using the most recent available information from Treasury. The black line shows that over all long-term securities, the foreign share of all long-term securities increases over this time period from about 12% up to about 20%. But but that average doesn't really tell us a whole lot about what's going on underneath the hood in terms of the kind of assets that foreigners tend to emphasize in terms of their own portfolios, which we'll look at in a minute. And so if we decompose asset classes into sort of the standard set of asset classes, and we look at U.S. Treasuries, which is the red line, foreign share of all U.S. Treasuries outstanding goes from about 40% of all U.S. Treasuries outstanding owned by foreigners. This is a statistic that you're probably familiar with, rising up to, in the sort of the height of the kind of the crisis, foreigners holding 60% of all U.S. Treasuries ever issued and held by the public sector in January 2008. And it's come back off of that a lot. And the reason is not so much because foreigners don't like Treasuries anymore, but because we have another buyer in the market who likes them a whole lot, and that is, of course, the Federal Reserve. So a lot of the decline in the percentage that you see here from the 60% down to a little bit over 50%, that's primarily because of the presence of the Federal Reserve in the U.S. Treasury market. And we can talk about, and the evidence is very clear that they've been buying them from the foreigners as much as from the domestic. So the other type of debt that we might want to consider when thinking about foreigners playing a role in the U.S. markets are corporate debt, which is the purple line. So foreigners hold, maybe 20%, maybe 25% of all corporate debt that's ever been issued, the corporate bonds, long-term bonds. Another kind of category that we've paid attention to in the past is foreigners owning the GSEs, the agency bonds, Fannie, Freddie. And there was a terrific interest on the part of foreigners to own the GSEs, owning ultimately, again, at their peak, about 20% of all GSEs outstanding were held by foreigners, principally by the Chinese, because, again, they were kind of a no-risk, high-return financial instrument. And so foreigners who at that point were holding a tremendous amount of treasuries wanted to diversify. In their view, diversification meant into GSEs. And, of course, that's come off because GSEs have less of an attractive component to them now. So what do we have left over in terms of securities that we might want to pay attention to? A foreigner's role in U.S. equity markets, very small, but rising, from about 8% up to about 12% of the value of the U.S. equity market is owned by foreigners. And then what do we have down at the bottom, and which doesn't really move a whole lot? Municipals. So when we take the perspective from the domestic market, the exposure of the domestic market to foreign ownership in the municipals is really, really small, under 1%, and really hasn't moved at all. So when we juxtapose that against the the press commentary, it's like, well, there may be individual examples that we find that capture the attention of the press, but when you aggregate up, you just don't find a whole lot. So another perspective, though, that we can take is from the perspective of the foreign wealth portfolio. So I'm a foreigner, I've got a portfolio of wealth, I am going to allocate it to various types of assets. And so this chart looks at the composition of that foreign wealth portfolio and how it has evolved over time from 2004, this is quarterly data, up until the second quarter of this year. So looking at this, you can look at the portfolio composition of the asset classes of treasuries in the blue and corporate bonds in the greenish, and then equities. And these each had about 20% of the foreigners' portfolio were allocated into these three asset classes, nice balanced portfolio. A little bit less on the GSEs, even less on mutual funds and munis and money market funds, basically, again, zero. But that behavior of the foreign investor class portfolio allocation strategy altered dramatically in the financial crisis to be overweight, dramatically overweight, and increasing into U.S. Treasuries, a reduction in corporates, Again, we're really running off the GSEs. And what's interesting, I think, about this chart, there are a couple things, but the most important part I think that we ought to be looking at here is the rising interest on the part of the foreign investor to allocate their portfolio towards a somewhat riskier asset class than they have held in the past. Now, in some sense, this is exactly what the Federal Reserve wants the world to do, to move toward a riskier asset class. And now they haven't really made the foreigners do it too much, because of course we still have treasuries at the highest percentage, but it's this increasing share of the equities is on the back of corporates and GSEs. Now this money market, I'm going to note for you, because I'm going to come back to it, as a very interesting development, I think, in terms of the interest of the part of the allocation strategy of foreigners into a new asset class, which now 5% of their assets. So this, again, is the all foreign investors. So if we took all foreign investors and we took their wealth portfolio, this is how they would allocate it, and this is how it's evolved over time. What it looked like before the crisis, which perhaps we can think of as a normal allocation, and then where it is now and how it has evolved in the crisis and through the various stages of quantitative easing. If we look below that, however, and we look at foreign official versus private investors, the composition of these two wealth portfolios is dramatically different. The composition of the foreign official portfolio, 75%, and very little change in terms of U.S. Treasury securities. So foreign official are the dominant holder of U.S. Treasury securities. In contrast, the foreign private portfolio, U.S. Treasuries here are down at about 14%. So that's if we look at the average, we're not getting the behavior of these two different investor classes, and we think that these two investor classes act differently, which is why we need to do the decomposition. In terms of other assets that are, again, something to think about when I'm going to get to the end here about, whether foreign investors are going to be the new kid on the block in terms of owning munis and the manner in which they may own munis. Looking at equities, here we have the rising equity component, very small. It's 18%, but it's rising over this time period. This is actually a much shorter time period, 2011 September, so it's just about a couple of years. And the reason why it's a shorter time period is because this decomposition of asset portfolio into the foreign official and the foreign private is only available since then. So it's a very recent data availability. It also comes from the U.S. Treasury. Rising share and dominant share of the foreign private portfolio in terms of owning the equities. Okay, so preference on the part of foreign privates for equities, preference on the part of foreign officials for U.S. Treasuries. Both of these cases, munis are at the bottom. Again, zero, but not quite zero, and not zero in the same way. Even though they both look like they're zero and they basically haven't changed, as a percentage of the portfolio, foreign private holders are about 10 times more important than foreign official holders. So even though they look like zero, if there was some change in the behavior of the foreign private holders, private wealth investors abroad, their change would have a change in that attitude, change in the perception of should I buy munis, and maybe how should I buy munis, maybe if there's a new financial instrument that is a package of munis, maybe I'll pay attention to it. So when the foreign private portfolio shifts, they are more important. Foreign private investors own 2/3 of all U.S. investments, even though they don't own 2/3 of the treasuries. They own 2/3 of all of the private investments, and their holdings of munis are 10 times larger than is the foreign official portfolio. So it makes sense to look at them, even though it looks like they're flatlined. So what else can we say about whether or not munis are an important, are interesting for foreign investors? So if anybody knows whether or not somebody is interested in a piece of information about munis, it should be Google. So I'm going to toggle to my Google Trends website. And if you're not familiar with Google Trends takes their search, all of the Google search data that they have out there, and then they parse it out by what have been the search terms that have been used by searchers around the world. And so the two terms that I'm going to show you are municipal bonds as one term and treasury bonds as another term. And over this time period, which starts in 2004, there's been much more interest in treasury bond as a term that has been in international searches, or national and international searches, and versus municipal bonds. Well, that's not too surprising, but I want you to look below. They tell you where in the world these searches have been important. And let me show you the treasury bonds to reveal that, in fact, there is global interest in searching on the terms treasury bonds, and it is U.S. treasury bonds, because I can see down here, these are the related searches, okay, U.S. Treasury, blah, 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 and these are the ones that are becoming more important in terms of the global search. So there is interest around the world in the U.S. Treasury market, even more interest in Hong Kong than there is in the United States. But look at the other financial capitals: Singapore, Philippines, Australia, Canada, and even India. When I put in, this is exactly the same thing, when I ask Google, who knows everything about everybody's searches, and you know that, right? And you ask Google, are there people around the world who are searching for the terms municipal bonds? The answer is no. That the searches for municipal bond terminology is so small that Google will not report it. So, this says something about whether or not, the zero lining and the flat lining that I'm showing you on all of the official data, is that wrong, or is it basically right? And, looking at Google and asking Google the question, they basically say, no, there's nobody interested in that out there, or not enough for us to warrant showing you the data in terms of the way we present it in Google Trends. So going back to other potential sources of data, and going down to where we were, so Google can't find it. What about going and looking at the Municipal Rating Standards Board's data, which I think is a fascinating data set? Here is an example of information that you can get about the number of trades by various trading groups. You can also get, quotes on the volumes and so forth. And this is the time period that they have the data for. So a lot of trades by customers, okay? And here is the spikes that John has on his are going to be reflected in the same spikes here in terms of trading activity. So I know that there were a lot of trades. I know that there were a lot of customers buying. I know that they were selling down here. I know that the interdealer stuff, the interdealers were the real active guys, but I don't know anything about the buyers. There's nothing on this website about the buyers. So every time we hear something about, foreign bought something, it is only a single data point. Because until we get more information about the buyers, we can't really consistently ask the question about foreign interest in municipal securities. We can make guesses, but there's no consistent data set, and it all becomes anecdotal, except for the Treasury and the flow of funds data that specifically strip out foreign owners of those type of assets. So this takes me to sort of a future-looking part. Last couple of slides, the future-looking questions are, well, if I'm a foreigner and I'm thinking about investing in this asset class called municipals, what do I think they are like in terms of the asset classes that I'm familiar with? Are they like a U.S. Treasury security, which is very dominant for the foreign official investors, but the private doesn't care about it? Well, they're probably actually not like a U.S. Treasury security because they're not no default anymore. Whenever we thought about no default, they're not default anymore. Are they like a GSE in that they have a quasi-government backstop? Well, we might have thought that they were like a GSE before, but we don't think about them that way anymore. And in any case, as a foreigner, my attitude towards this particular asset class is not favorable. What about, is it like an asset-backed security? Could I imagine municipals being like asset-backed securities, a package, municipal bonds? Would I buy that if I was a foreigner? Well, the attitude these days is, well, it is a sausage. Asset-backed securities, they're like sausages, right? You don't really know what's in them, and probably you don't want to know, or you didn't want to know what was in them before. You got a lot of high yield out of it, and that was good. And you also liked it because it acted like a bond, not an equity. It was a bond. But, if we think munis are going to be like asset-backed securities going forward, foreigners aren't going to like them because they got so burned on holding those sausages that, especially the German banks, of course, they don't want to hold asset-backed securities anymore because they want to know what's in them. So what about thinking of munis as a mutual fund? Can we think about taking munis and turn them into something that foreigners would understand as being like a mutual fund, where it's diversified, it's exchange-traded like equity? The foreign official investors don't like equity. I showed you a chart that said that basically they don't own any equity or very little. On the other hand, the private sector does. The foreign private sector likes equity a lot, and this is where I'm bringing you back this chart that shows the dramatic increase in the share of foreign investors' portfolio being put into mutual funds. And to the extent that there is an avenue towards which munis, securities, can be turned into something that looks like a mutual fund, they will find an attractive, they will be attractive to the foreign investor. So, is the foreign investor the new kid on the block? I would say it hasn't moved in yet. That new kid has not moved in yet. Foreign is a tiny share of the outstanding issues, and munis are a tiny share of the foreigner portfolio. On the other hand, is opportunity knocking on one of those houses on the block? I don't know enough about the muni market. This is not my area of expertise, but it's very clear from the little bit of work that I've done, it's massively fragmented, 80,000 jurisdictions. Nobody knows anything about them except for, we heard a little bit about, from Mary, it's like you have to get really down underneath the hood to know what's going on in them. Foreigners don't want to do that. They're not standardized in any way. There's no liquidity. So if there's going to be any sort of foreign interest on a systematic basis in this type of security, we have to ask for what are the financial intermediaries going to do. This is a real opportunity, in my view, for municipals to become a packaged security. But they won't be an asset-backed security. They will be a mutual fund of some sort. And who's going to do that in order to be able to sell a share of mutual funds that's going to look a little bit more like a bond and then a pure equity, and who you're going to market it to? And I would argue it should be marketed to the private sector. Thank you.
Thanks, Kath. We have time for a few questions. I would tell you that after what Catherine just showed us, if I want to leave Cumberland, I guess my next job should be as a wholesaler for a municipal ETF because the world would be your oyster. There's nobody out buying. Yes, Harv.
I have a question for Robert. You had a chart that showed an increasing percentage of junk and worse than junk rated municipals showing up over time. And your company and its competitor companies have, one of its competitors anyway, has 100 years of experience in rating corporate bonds. And I've always trusted the ratings with a little bit of caution. But when new instruments or evolution of old instruments begins to happen, and we end up with new categories that weren't there before, and there isn't 100 years of experience or 20 years of experience or even 5 years of experience, what is your company doing to look specifically at some of this higher risk end, and how confident are you that a C rating really is a C rating and not a D rating, even though it's not in default yet? In other words, what's your experience level here, and where are you going, and how do you specialize in looking at some of the higher risk ends?
All right, thank you. Thank you. Thank you. No? Is this on now? Oh, there it is. Okay. Thank you for the question. Again, my area is municipal finance, where we have, as I pointed out, just a very slim level of experience with these below investment grade ratings in the first place. I would point out that for spec grade ratings for Moody's, our ratings mean something different than they do for some of the other companies. We don't have D ratings, for example. Our ratings go down to C level, which is the lowest rating we have. And at each of these rating levels, because we rate to something we called expected loss, each of the rating levels has embedded within it our expectation of what recovery is. So, for example, a CA rating might have a 60% recovery. A CA1 might have a 70%. A CAA3 might have a 30% recovery rating. So we are looking at our best assessment of what we think recovery is going to be for these entities that are in or near default. The municipal experience has been very slim in this regard. What we have learned through this down cycle so far is that our prior expectations of what recoveries were going to be for entities in or near default was a bit conservative, a bit generous, that we thought recoveries would be very high. What we're learning through the Detroit experience, which is still being worked out, what we're learning through Stockton, which is still being resolved, is that losses in the municipal sector, once you hit this below investment grade threshold, could be a good deal greater than we had prior experience. And we're going to have to build that into our rating constructs, and it will affect our views of underlying ratings and affect our views of the guarantors, who is, we talked about earlier, are sometimes in the business of guaranteeing some of these more speculative grade credits. But again, the experience is pretty thin, as you can see. It's not very robust. We publish default studies every year. We try to keep our ratings as current as we can. We're learning from all these experiences as we go along. But we're in the opinion business, as you are. We've been very clear that, our opinion is one opinion. It takes many opinions to make a marketplace. You should have your own opinion as well. We try to have as informed and current opinion as we can and try to update it as events unfold.
Any other questions? I want to throw one question out. And actually, I guess it would be to Bob, but Mary, you might want to take a shot at this too. When you think about the general obligation credit and the full faith and credit promise to pay, and you get into these more tortured situations, I'm amazed that asset sales don't happen on the part of municipalities, at least to an extent to satisfy some of the obligations. It seems like they get held back. The excuse is we've already reached the tipping point on taxes, we can't do anymore, therefore we're declaring bankruptcy. In other words, we haven't taken the steps that, if you looked in the OS, that you would think would be required to be taken. I just want to throw that question out as, Is that something that it will change in the future due to more stress, or is it something that's just a pie in the sky?
Well, again, the experience is very thin here because we haven't had this incidence of default. I mean, asset sales have occurred for credits throughout the rating spectrum. We've had, as downturns come along, governments, fairly regularly have sold assets as a way to balance their budget, and it's a buffer. It helps them. It's a hidden reserve fund. It helps them to get through difficult times. So asset sales, are not unknown. What we are now encountering in Stockton and in Detroit is a situation where bondholders are either having to claim, collateral, as Mary was talking about earlier in the case of Stockton, or Detroit in terms of selling off some of their assets. Most popularized, I guess, is the Detroit Museum of Arts. But I think the question for asset sales, particularly as it sort of now is kind of emerging in the Stockton case, is particularly troublesome and very kind of contrary to what we've traditionally thought about in the muni world and in terms of credit analysis, where we look at essentiality as a key component of the rating. So if you were selling a bond to pay for a sports arena, we might think that that's less essential than if you're building, a prison that the entity might need. What we've discovered with Stockton is that they are sort of cherry picking their credits. They're looking at the various credits, certificates of participation that they've either sold for things like parking garages or buildings, and saying, gee, we have 100% tenancy of this building, so we want to keep it, so we're going to pay on this comp, and we've only got 2 floors out of 10 in this other building over here, so we're not going to pay for that one. Or we don't really care if there were unsecured pensioners, unsecured creditors around the pension obligation bonds, let them go try to collect against the pensioners. So they're creating a whole new hierarchy of essentiality and choice around what they want to pay and what they don't want to pay and what's of value to them and not. And again, this is one instance. We have 18,000 municipal ratings. We've got a very slim history, but we're all learning a lot about how distressed credits behave through this very severe business cycle. That may impart some very different behavior than we've traditionally thought, and we're working very diligently to try to embed this into our rating constructs. Now again, some of these situations that we're talking about are still in process. The Detroit bankruptcy has not been resolved. The Stockton bankruptcy is in the process as well. Obviously we need to see how these conclude, and once they're concluded, we need to embed the lessons into our rating constructs.
So, from my, your question is about why isn't it that when a governmental entity goes into bankruptcy that there aren't asset sales used to fund the pay off the debtors?
More than you see, right?
More than you see. Well, from my perspective, international capital flows and sovereign debt crises are the lens that I look at through these. For that question, and a sovereign debt crisis, and of course Greece is the most recent one, but 1997 you have all of Asia, and the story is over and over again. First, it's a fire sale price, and we're not going to sell it at a fire sale price, and that's equally true of a locality or a state. And the second issue that is the similarity is we're not going to sell something that is a national asset. It's a sovereign debtor. We're not going to sell a national company. We're not going to sell a national asset. It belongs to the people, right? So, that's the same kind of terminology and language and thought process that's coming up in the context of, for example, selling Detroit's art. It's like, it's not Detroit's to sell. It's not Detroit's to sell.
Good point.
And they'll never get a good price for it, so why would you do it?
With that, I'm going to turn it over to David Kotok for a few closing remarks, and we thank you for your time.
Let me thank our wonderful panel, both panels this morning, for a great discussion. The speakers at our conference yesterday and today, the CFA Society for partnering with us, the City of Hamilton, Bermuda for giving us great hospitality. A couple of just observations on this morning's session. It's the first time the Global Interdependence Center has looked at state and local government, particularly cities, in a context. Our organizational name is global, not local. Catherine noted that there is the possibility that some of this might be global. And if you think about the size of the market, it's 3.7 trillion. It's denominated in US dollar, and it incorporates many, many diverse issues of various types. We talked about them this morning. What we're seeing in our little firm of Cumberland, for the first time since the financial crisis, and previously we didn't see any of it, is we have a history of 40 years in this sector of state and local government bonds. And we now have several small, foreign, sovereign, national funds who are using us to manage portfolios for them in the municipal sector. Now, that's in that blue line, that's above zero and barely noticeable. The other thing that we see is they have to go through a structure to position those funds in the United States in trusts and vehicles which are therefore compliant with the Patriot Act and various reporting mechanisms. And so it's my opinion, and this is an assertion, an opinion, that those clients don't appear in a breakout way where they can be isolated. And perhaps that will change over time. There was a question on derivatives and cities, and to Dennis on the competency of city managers and finance officers. We have something new there in the United States now. For the first time, municipal issuers need to have expertise to help them, and that expertise now has a licensing, registration, investment advisory component. Prior to this crisis, anybody could hang out a sign and say, I'm a financial advisor to a municipality, come see me. There were no rules. There might have been local rules, but there were no national rules. So that has changed, and perhaps that will improve the issue on derivatives. I'm really struck by Bob's slide that says more negative downgrades, they are outnumbering upgrades. And thinking about that, we commented earlier when Dennis said we have to go through a crisis to get to the building and growth, and Mary is representing the last high-grade bond insurer, and she can't talk about the ones who are no longer standing, but I can. And think about what this world was 6 or 7 years ago, when half the bond buyers said, oh, it's AAA insured, and I don't even need to know anything about the underlying credit. How much of that has changed? So we have a remarkable industry section It's worth almost $4 trillion. It's in a transition that none of us could have forecast 6 years ago, and we have no idea where it's going. And so the only thing we have is perhaps the ability to come again to this beautiful city, which doesn't have a financial problem in the future, and get updated. I hope you enjoyed the conference. Lunch is in the gazebo room. Thank you very much.